Next, please allow me to introduce you Dinda Elliott, Director of the Center of Business at China Institute. Dinda will be moderate our next panel on macroeconomics and take us to the outlook for 2018. Let's please welcome them.
Both countries suck.
Okay.
Oops, we're coming. Okay.
I listened a little bit, but I won't get it with some. Sometime I'm in Boston.
When are we going?
I know.
No.
Too much chit chat in the green room.
Good.
And I'm actually not. I'm here more than I'm in LA. So
okay.
Wait till Boston.
Yeah, I know.
Okay,
I got it. Okay. Yeah. Here, got my stuff here.
Don, you're on. We're listening to you. Good morning, everybody. So we're in for a real treat. I mean, there's probably no subject more important right now than China's economy. As we all know, as China's economy goes, and as the second largest economy in the world, so goes the world. And so we have here three of the world's top economists who've spent decades focusing on what's going on in China, and I'm delighted to introduce them in alphabetical order. We have Andy Rothman, who's an investment strategist at Matthews Asia, and was just telling me that his first trip to China was in 1980, so he's been watching this place very, very closely for a long, long time. We have Stephen Roach, who's a senior fellow at Yale's Jackson Institute of Global Affairs and former chair of Morgan Stanley Asia. Stephen has written lots and lots of stuff about China and has been following it for decades as well. And we have Donald Strassheim, who is senior managing director at Evercore ISI, and he heads the firm's China research team. And Don has been focusing on China for decades as well. So we're really, really honored to have all of you here today. Thank you. I'm just going to jump right in because time is precious, and I'd love to get from each of you a kind of a snapshot. I mean, there are China bulls who say that post-19th Party Congress, China is now going to go roaring ahead, the direction is clear, and innovation is incredible, et cetera. And then we have bears who say that there's no SOE reform, the debt problem is terrifying, that there could be a real problem ahead. So I'd love to hear from each of you, a 2-minute snapshot, and then we'll dive in more deeply to, what are you looking at right now? What's your top concern for the Chinese economy over the coming couple of years? Why don't you go ahead, Andy?
I think if I have 2 minutes, what I would focus on in terms of explaining why I'm relatively optimistic about the future is just change. And I think a lot of people who are pessimistic maybe don't understand how much things have changed in a relatively short period of time. As you mentioned, when I first went to China in 1980, there were no private companies in China at all. You couldn't even find a privately owned restaurant. Now it's become, in a fairly short period of time, very entrepreneurial. More than 85% of urban employment, all the new job creation in China is from small entrepreneurial private companies. A lot of the people who've been really bearish on China have been making the argument for more than a decade that China would not be able to rebalance its economy, that is, shift away from a focus on manufacturing and investment to a consumption and services-driven economy like ours. Well, last year was the 6th consecutive year in which the largest part of the economy was the consumer part. About 2/3 of economic growth came from that. So they do face a lot of challenges. Debt is certainly one of them, but I think the pragmatism from the Communist Party when it comes to dealing with economics, the willingness to change and give up control in many areas of the economy is one of the reasons that I'm relatively optimistic about the future.
Stephen, what do you think?
I am always wary of the black and white. You're either a bull or a bear. I prefer to be a realist and think about both sets of considerations. I mean, generally, I've been in the camp of focusing on the same type of transition that frames the thrust of this conference that we heard in the keynote speech. In fact, I've taught a course at Yale for the last 8 years called The Next China, and my lawyers are contacting ANLA for copyright regarding the title of this conference here today. But I think it's important to note that this rebalancing to consumer and services-led growth, which I've written books about and frames my course, it's an incomplete rebalancing. China's done a terrific job in sort of the industrial engineering piece of this by boosting the development of the services sector and pushing ahead aggressively on urbanization. And all of this together raises the personal income share of the Chinese economy a lot. But the facts are that the consumption share of GDP has moved up only a little bit. And no one, everybody's been celebrating here the miracles of consumer-led transformation, but discretionary consumption is just not, at this point, powering the economy the way in which those of us who have been optimistic, like myself, on rebalancing have been expecting. You've got to get private consumption above 40% of GDP, which it is not today. And the missing link, I think, is the social safety net and the failure of the government to really fully fund retirement and health care in a way that gives Chinese families confidence about the future to step up. And so my bottom line, Adinda, is that the rebalancing being incomplete leaves China still heavily reliant on the model it's trying to move away from, investment and exports. That's a debt-intensive growth at a minimum. It's also a growth that is highly dependent on the state of global demand. And I think the big risk for China as we move through this year is the possibility of a global demand shock made by America's 45th president, who's about to unleash some protectionist actions against China later this month.
Mm-hmm. Thanks. Don?
We're bullish about China for this year, for next year. Ought to be good growth. We'll get a host of official numbers tonight. Quite frankly, we watch those numbers out of a sense of obligation rather than a sense that we're going to learn anything about the economy. The data is too opaque, really, to rely on. But there are a lot of other numbers that you can rely on that are really volumetric numbers: electricity consumption, container traffic, railway freight, passenger car sales, commercial vehicle sales, those kinds of things that will tell you something about the economy. The farther out you go, the more nervous we get about the outlook. It's crystal clear to us that China's economy is in a long-term structural slowdown. 20 years ago, China's growth rate was 10% a year. That was 2% labor force growth and 8% productivity. Now their GDP growth and potential is about 6% or 7%, doesn't really matter. That's 0 labor force and 6 productivity. You go out a decade, that productivity number is going to be 4. The labor force is going to go to -1, 3% GDP. That's a reality. Deal with it. Doesn't cause social unrest. Social unrest occurs when the people want to go one way and the leadership wants to go another. That was French Revolution 1798. That was Tahrir Square, Cairo, 2011. That's not China now. It's not going to be China in the next few years. Our biggest worry beyond just this broad slowdown is something that happens overseas.
In terms of Donald Trump, and is there going to be trade, a trade war, et cetera. So how do you analyze the risk, and what do you see in terms of whether there could be a trade war? I guess people are expecting that Trump might come out with some really, strong measures soon. So what are you seeing?
Well, I have to preface this by saying that, of course, analyzing Donald Trump's thought process is difficult. But I'm less pessimistic than most
not
people.
Not a Walter Reed yesterday.
I'm less pessimistic than most people about this. It's true that Donald Trump has been using pretty harsh language about China for many, many years, including during the campaign. But he did nothing on China trade last year and has been very positive in his comments about his personal relationship with Xi Jinping and how China has treated him. And I think that's going to color his view versus his advisors. And he's certainly surrounded by people who would love a trade war. But he's got to think about other things. Donald Trump is taking credit for the strong performance of the U.S. stock market. Does he worry that a trade war with America's biggest trading partner would disrupt that? He has to be concerned about retaliation from a trade war. And one of the first places I think the Chinese would retaliate would be by reducing significantly their purchase of soybeans from the United States. And he's got to be having a lot of Republican congressmen from the Midwest saying, we could lose some significant number of seats during the midterm elections. He might, if you're a cynic, think he's concerned about the future of his family's businesses in China should he start a trade war. If you look at the national security strategy document that he published in December, very harsh on China and on Russia, but in the speech that President Trump delivered to launch that, a very different tone. So I think what we're more likely to see in the coming weeks is very modest steps on China trade, a little bit on steel, a little bit on aluminum, a little bit on solar panels that will not add up to a significant impact on trade or on the Chinese economy, but he'll couch it in trade war terms.
Right.
But Xi Jinping's response, I think, will be moderate, proportionate, because the reality will not be significant. So then at my firm, we're ready. If those trade war headlines lead to an increase in pessimism, a fall in valuations, we would see that as a buying opportunity with the expectation that after a couple months, most people would realize that a lot of tough talk, but not much action.
That's so interesting, and I want to hear the others chime in on this too, but that question of kind of political psychology that you're talking about, the impact of headlines, and what I wonder as a kind of a follow-up is all the stories that we're reading about the challenges that American companies and other foreign companies, but American companies are facing in China vis-a-vis restrictions, et cetera, and they're voicing their, unhappiness about technology transfers, all that stuff. That also then feeds into the sort of news cycle of hysteria and then feeds into the political process as well.
We don't hear very much from the American companies that are doing well in China. For example, GM sells more cars in China than it does in the United States. Boeing delivers more aircraft in China than it does here. U.S. farmers, about half of the soybeans they produce are going to China. It's our biggest agricultural market overseas. U.S. exports to China have grown by 500% since they joined the WTO. We don't hear about that very much and the jobs that supports.
Yeah, I think unfortunately, it seems like because of the political environment, these companies are not willing to kind of stand up and speak the truth about how important China is to them in terms of their own businesses, right? Did either of you want to chime in on the trade war question?
I'd just add a little bit to this. I agree that with the basic point that both of you just made, that China is an important source of export growth in the U.S. I think the numbers show over the last decade that China is the third largest behind our two NAFTA partners, which the president is now going after as well, but clearly our most rapidly growing major export market in the world. The analytical problem I have with this fixation on China is the failure of the Washington consensus in general. And here I don't just condemn this administration, but I condemn earlier administrations of both parties to underscore the fact that when you don't save as a nation and you want to grow and consume, you run, by definition, large current account and multilateral trade deficits with many nations. Last year, we had multilateral trade deficits with 101 nations. China's the largest. We can get into the numbers. They are distorted, but even adjusting for the distortions, China's still the largest. There are lots of reasons why that is the case. The U.S. trade rep, Lighthizer, has initiated Section 301 investigations in 3 areas: technology transfer, innovation, and intellectual property rights. The sort of inside backstory on those investigations is that the findings are now have been circulated, and they make a compelling case for intervention in the form of U.S. trade sanctions, which the president is prepared or is preparing to move ahead on. There will be consequences, as Andy just said, if he does that, and the Chinese, I think, are also preparing their own counter response. But I guess the final thing I would say about this is that the trade frictions that could well be coming to a head later this month, at least for the time being, have been building for a long time. They go back well before America First and Donald Trump. And they actually were kicked off right around, I want to say 2005, with anti-China currency bills sponsored by none other than now minority leader, maybe possibly majority leader, Chuck Schumer, a liberal Democrat from this state, and Lindsey Graham, who's now become a household word for other reasons, conservative from South Carolina. The bipartisan support for going after China is deep and has a long history, and I think maybe something that we would be surprised to see support on both sides of the aisle from, should the president move ahead in that area.
Don, did you want to chime in on the?
Yes, so Andy raised the open question about what's in President Trump's mind. I'm just a China guy. I speak personally. I'm a global guy by background. My view is that President Trump has no views that are relevant to his job as president. He has no information that's relevant to his job as president. I think he has no inclination to gain any views or information. And accordingly, it's really hard to know what he might do. I think whatever actions Washington takes will be targeted, not broadside. 301 actions, a host of those. And I think Washington writ large believes that our trade war is a lose-lose rather than a lose-win or a win-lose or a win-win. I think that's the case in Beijing as well. So I'm reasonably optimistic that they tinker around at the edges, but not much more than that.
With possibly some big talk and headlines, but not so much
lots of bark,
fundamental.
not so much bite.
So let's shift back to China and the domestic economy. Let's talk about debt. We were talking earlier about the fact that the local debt at the local level has risen very rapidly in recent years, and is more than 250% of GDP. So there's lots of concern about the debt, and I'd love to hear you each chime in on how concerned you are about that overhang at the local level, and is there, I know the extreme is, there could be a financial crisis, but how do you see it in terms of that as one extreme, and I guess the other possibility being that China just moves into, that it just becomes a real slowing factor for the economy. Talk a little bit about debt. How worried should we be about it?
We should be concerned about it, but I don't think it's a significant risk to a financial crisis in China for a few structural reasons. First of all, we have to recognize that local government debt in China is not like local government here. Every local government in China is just the branch arm of the Chinese Communist Party, so it's all central debt. We have to recognize that this debt buildup began as the Chinese government's response to the global financial crisis. Back then, exports were a bigger part of the Chinese economy. When exports collapsed, lots of young people lost their jobs. The Chinese government implemented probably the biggest Keynesian stimulus since Keynes, bringing forward a lot of infrastructure construction to soak up the unemployment. They paid for it with bank loans, and that's coming due now. But it's also important to recognize that these loans, this debt, was created by the state instructing state-controlled banks to lend money to state-controlled companies to build state-directed public infrastructure. So there's no private participation here. There's no mark-to-market pressure. There's no equivalent of a Bear Stearns or Lehman Brothers. This doesn't mean that it's not a lot of money that has to be dealt with, but it does give the Chinese government the luxury of deciding when and how to deal with it. And they're starting that process now. So I think the risks of this resulting in a Western-style financial crisis in a country that doesn't have Western-style banks is very low. So I think what it will do is put increasing pressure on the Chinese government budget. The fiscal deficit to GDP ratio will rise, and over time, the government's ability to spend money on things like education and healthcare, cleaning up the terrible pollution problem will be constrained, but that's a really different story than saying the banking system's going to collapse next year.
Yep.
Yeah, I would, just dig a little deeper into what Andy just said, because I agree with the basic thrust of what he's saying. But in looking at the BIS numbers on debt for China, I think you can definitely go a little bit further. I think it's probably wrong to say that the private sector has not participated. I mean, the numbers I'm looking at right in front of me show the private enterprises debt to GDP ratio was about 30% in 2008, and in 2016 the number was about 55%. So it's gone up, but not nearly as much as it has in the state-owned enterprise sector, which for reasons that Andy just articulated are by far the more debt-intensive sector of the Chinese economy. And this gets into one of the biggest concerns I have with respect to the government's management of the system, and that is the failure to really move ahead aggressively on state-owned enterprise reform. Mm-hmm. This whole new sort of celebration of this new phase of reform being framed around these mixed ownership, capital raising initiatives. The sort of the poster child for that was the China Unicom deal done last August. This is financial engineering. This does not really deal with the need to really refocus, delever, and restructure state-owned enterprises in a way that really creates a more dynamic and sustainable, less debt-intensive sector. And we talk a lot about the contradictions of China, and this belief that has been at the heart of Xi Jinping thought, if we can ever figure out what that means, that was articulated starting in the third plenum of the 18th Party Congress as allowing markets to play a decisive role in shaping the economy, but unswerving support for the ownership of state assets. How do you square that circle and these state-owned enterprise reforms that are now being rolled out just kick the can down the road, and that's worrisome from the standpoint of debt and sustainability.
Don.
President Xi's favorite three-word phrase to summarize state-owned enterprise reform is improved state management. That's never going to make it.
So is that an oxymoron?
Taking two big, old, inefficient, bureaucratic state-owned enterprises and making them into one giant, big, old, inefficient SOE is not really progress. It's sideways. I think the irony in China, to me, is we all see some substantial opportunity for great long-run growth in China. Yet, China's equity doesn't have an equity market or a debt market that is coherent. Xi Jinping on July 4, 2015, broke BRO-KE, the equity market, to break BRA-KE, the fall in equity prices. That told us, that was important for the equity market. It told us a lot more about who Xi Jinping is. And on the debt markets and the banking side, they could easily go back and do another bailout like they did 05, 09, in which they took, before the IPOs, the big four SOE banks, take the bad loans off the books, put them in central region in their back pocket, write a check from the Ministry of Finance, say, here's replacement capital, now go about your business being a state-owned bank. They could do that again if they want. That's not really progress. That's just a patch. And you can't have a debt market, at least on the corporate side, unless you know what paper is protected and what isn't. Until you have that, and they don't now, and there's no evidence they're going that way. It's stunning how we can be optimistic about the long-run future with neither of these two ways to finance the economy.
Can I follow up on
Please, please, please.
I agree with Stephen's example with China Unicom being completely counterproductive, but there are other areas that are leaving me a little bit more optimistic. For example, if we look at coal and steel, two sectors with significant debt problems, headcount, the number of workers in both of those sectors has gone down by 25%. That's more than 1 million workers in each coal and steel over the last 3 years. And I think overall these supply side reforms are starting to kick in, and this is a key reason why last year the growth rate of profits of Chinese industrial firms was about double the speed it was in the prior year. Last year we saw overall industrial operating margins at levels we haven't seen since 2011. So I think they're starting to make some progress. It's not as fast as any of us would like it to be in reducing the overcapacity problems, which then addresses the debt problems in the state-owned enterprises. But still, I think the growth in the private sector is not going to come from that. It's coming organically, just the unleashing of the entrepreneurial force, and that's really the main place where we're investing our clients' money.
Can I just ask
Please.
Andy a question? I bring these charts around with me because I can't remember everything, but I'm looking at a chart of SOE layoffs, and I'm struck by the contrast, Andy, between the period of 1997 to 2005, where cumulative layoffs in the state-owned enterprise sector were about 37 million, according to estimates put together by the IMF, which you can pull out of the NBS data in China as well. And you're right, they're doing layoffs now, but they're less than 2 million. So what's the difference between a government that really went aggressively after this excess capacity and the headcount associated with it, to unleash at that point, a more of a broad-based set of reforms, and a government that is so fearful of really being aggressive in dealing with arguably what could be just as serious an excess capacity problem today as it was back in the late 1990s.
Yeah, I think that there are two things that explain why the number of layoffs is lower now. My count is back in the late 90s, we had 46 million state workers lose their jobs over 6 years. That's equal to laying off the combined workforces of France and Italy in 6 years. Dramatic, and very few people are aware of it. But back then, state-owned enterprises accounted for almost all of employment. Today, the share of state-owned enterprise employment in the total has gone down dramatically. As I mentioned earlier, more than 85% of employment's in the private sector. The second reason for a smaller number is that the next round of layoffs has to come in China's existing Rust Belt. So in terms of social stability, this is a real concern. If you've already got an unemployment rate in the Chinese equivalent of Cleveland, which is double or triple the national average, it's a lot harder to keep laying people off there. And I think that's one of the reasons why progress is a little bit slower. They're worried about social unrest.
Can I jump in with another question about that?
I would just add a third point, though. A guy by the name of Zhu Rongji.
Who had a lot of guts.
Yeah.
Right. So if 85% or so of the workforce is now in the private sector, that's what you're saying, does that mean, I mean, this may sound kind of kooky and way out, but does that mean in some ways that we should stop worrying so much about the SOE reform question? I guess that's my first question. I mean, maybe obviously in the Northeast, you've got a real problem, right? That's a political problem. What are you going to do with all those workers who are going to lose their jobs up in the Rust Belt, area? But the second, I think this then leads to the point that Stephen was raising, which is the concern about the social safety net. That, I want you guys to talk more about that and what needs to be done in terms of resolving that problem. But first, are we obsessing too much about state-owned enterprise reform? Is it, the fact that, look, that's their political and their political economy is based on that. That's their reality. That is not going to change, and Xi Jinping has made it clear that it's not going to change, and that's going to be, certain strategic sectors. That's going to be the, core sectors. It's going to remain that way. Is there a chance that we're sort of getting it wrong, that maybe they can keep bumbling along with that, and then in the meantime, the 85% of the population is really driving growth, and that's a reasonable model?
Well, SOE reform is still really important, and we can see evidence of that last year, especially for those of us investing in Chinese equities. SOE reform is one of the reasons why last year was a great year for investing in Chinese equities, because overcapacity was reduced, profit margins went up. That has to continue. But for me, the more important things are, will the Chinese government continue to improve the operating environment for entrepreneurial private companies that are driving all the employment creation, all the wealth creation in China? And that, over time, means adjusting the tax laws, allowing private companies, as Stephen was saying, getting access to the financial sector.
Yeah.
And also, over a 20 to 30-year period, something that was discussed during the political session before us, moving to the rule of law and institutions that people trust. Right. Because over a long period of time, that's going to be the biggest problem in China. On the one hand, an economy and a society that are increasingly based on private property rights. On the other hand, the absence of the rule of law.
Right.
And that can't go on forever.
Yeah.
And look, just to the extent that there is legitimacy to worrying about debt sustainability issues, this is the debt-intensive sector of the Chinese economy, and continues to push overall levels of corporate and national indebtedness higher and higher. And so getting a handle on the link between the growth in the sector and their sort of seemingly unquenchable thirst for debt-intensive support is critical, and I think is very much related to the ultimate SOE reform issue.
Mm-hmm. Don, how do you factor in the social safety net issues and these questions into your analysis of the market?
So one point first about the debt question. I think the focus is more, and should be, more on de-risking rather than on deleveraging. Anbang, Dalian Wanda, Fosun, HNA have basically been put in the penalty box because their activities, in Beijing's view, was creating more risk to the economy, to the society, than economic reward. And to the extent that the GDP number is growing 10% a year nominal, and the debt number is 12, Beijing knows they're addicted to debt. They know that it's not a winning strategy to take that 12% number to 6% over 6 months.
It's not that they
that's
don't
got to
know
be 6 years.
Yeah.
So that's that issue. On the safety net, there will, and it's probably good news, there will never be a safety net in China like there is in any of the developed economies, because they have the damage done by the one-child policy has China now not the oldest society in the world, Japan is, but aging the fastest, different concept, and they will never be able to build a safety net like you have in the modern market economy. And when one child, two parents is the rule rather than the exception, you can't start a safety net. And the reason the savings rate is 50% or whatever the hell it is because people know that there isn't and there won't be a safety net, and they're doing what they think is in their own narrow best interest.
So what do you guys see, picking up on Stephen, when you were talking about the consumption share of GDP being relatively low, and totally understandable if people have to worry about, I need to take care of my parents, and what if somebody in my family gets cancer, and so all of these questions that people are worried about, the social safety net is not there for them to the extent it needs to be. What needs to change, and what does that say about, if China is trying to shift to a consumer-led economy, where is it, what needs to happen to really unleash those forces?
Well, Don just made the compelling point that it's a really tough problem for China to solve, given the demographic challenges that are here and now. There are several things, though, that can be done in light of this very clear. One of the most accurate things, by the way, that we can predict are demographic trends based on fairly clear understanding of birth rates, death rates, mortality, and the like. And the old age dependency ratio in China is now in the early stages of what Don was alluding to as a multi-year protracted explosion. There are a couple things that can be done to significantly alter that trajectory. They've done one. It remains to be seen what its impact is, but by moving from 1 to 2 to 2 children, you can reduce that old age dependency ratio by probably I don't have the chart in front of me that actually plots it out, so I'm trying to do it from memory, maybe by 20% between now and 2050. The big one can come, though, is if you lower the retirement age by, or excuse me, increase the retirement age by 5 years, which survival rate suggests is well overdue in China, from say 65 to 70. That will reduce the dependency ratio significantly, and so that will begin to, but not completely, address the concerns that Don just raised. The third thing that needs to be done, I think, is to for the government to really divert a fair amount of state capital into funding both national Social Security and national health care. Typical Chinese approach to dealing with these programs has been to boost enrollment, but not to boost the assets under management, and that just underscores the uncertainty about the future stream of benefits. So I think those are three things that need to be done. The government has really been slow in the second and third. They finally did bite the bullet on going from 1 to 2 children. It remains to be seen how many women are going to really move ahead and increase family sizes, though.
Can I make one quick point? One other one I would add is, if you simply leave the savings rate unchanged, but via better resource allocation, the rate of return on those savings is higher, you've got more savings, which is ultimately what you need.
Can I follow up on that? Because I'm a little bit more optimistic about the consumer side of the story. For me, China is the best consumer story on the planet. And this is despite the fact that the household savings rate's about 35%. Compare that to about 3% here now, I think. We've got inflation-adjusted retail sales.
Which is no model to be followed.
Not suggesting that. You've got inflation-adjusted retail sales in China running at about 9%. We get really excited if we hit 2% here. And this is being driven by some things which I think are sustainable. We've had tremendous income growth. In the decade through 2016, real inflation-adjusted household income on average rose in China by 130%, compared to 11% here. Now, off a much lower base, but what that means is that within the next couple of years, in dollar terms, the amount of spending by Chinese households is going to be bigger than it is here in the United States. And the savings rate's still high, household debt's relatively low, Chinese consumers are pretty optimistic. And the share of growth coming in the Chinese economy from consumption was 40% 10 years ago. It's not high enough today. It's only about 2/3, but it's rapidly moving in the right direction. And as investors, we're all about identifying the change, the trend.
So talking about consumption, let's segue to the property market. So how concerned should we be about that? It looks an awful lot like, with prices going up and up, it's a bubble, et cetera. What's your level of concern on those issues?
Well, I'm also optimistic about the property market. I think for me, bubbles are all about leverage. And one of the things that the Chinese government has gotten right is learning from our mistakes in our property market. So for me, if you want to understand what went wrong in our property market 10 years ago, you just need to know one statistic, which is that in 2006, the median cash down payment for a new home in the United States was 2% of the purchase price. In China, under regulations, the minimum cash down payment for a home is 20%, and every bank that we speak to is requiring 30% cash down. And we know from Hong Kong, for example, in 1997, when house prices fell 70%, because people had a lot of cash down, the mortgage default rate only went to 2%. And on prices, there's no question that house prices have gone crazy in places like Shanghai and Beijing, where I used to live, just like they're crazy in New York and the Bay Area where I live now. But Shanghai, Beijing, Shenzhen, Guangzhou, where house prices are up 85% in the last 7 years, those cities combined account for only 4% of new home sales by volume. In the smaller tier 3 cities, and these are not hick towns, these are cities with 500,000 or more people, house prices total over the last 7 years are only up 13%. And this is in a country where nominal income growth's been 10% every year. So I think that the biggest housing problem in China is actually a social problem, just like it is here and in the Bay Area, where too many people are priced out of the market. But that's very different from calling it a bubble, I think.
Can I just add one thing to that? We know a lot about the bursting of housing bubbles in places like Japan in the early 1990s, and then the United States in the mid 2000s. But in both of those cases, those were speculative bubbles that occurred in nations that were fully urbanized. China is not fully urbanized at all, and so even though the population's fixed, the urban population growth right now remains about 3% a year and will continue to be that way between now and 2030. And so that provides a really important source of support on the demand side of property markets that is was notably evident in markets that went through a catastrophic property market crises. Andy's point, though, on the sort of social maldistribution of housing is certainly very real, and the government's social sort of housing program is aimed at attempting to address that, and I would say, they're having reasonably good success, but certainly not perfect success, as we just saw with this migrant worker problem in Beijing in addressing this problem.
So if you don't mind, Don, we have 2 minutes left, so 2.5 minutes, so I want to just make sure to ask one last question, and that is, it's a big one, so if you can sort of, try to be concise, but I guess my real question is, what is, the area where you think you might be wrong in your own analysis of China? What do you worry about? And this sort of goes back to maybe it's a political issue, maybe it's the environment or social inequity or whatever might sort of pop up to challenge, your economic analysis.
Over the next 5 to 10 years, my biggest worry is just mistakes by the Chinese government, policy and implementation mistakes like we saw in 2015 with the stock market or the exchange rate. Over a 20 to 30 year period, it's what I mentioned before, the absence of the rule of law and the lack of institutions that Chinese people trust.
I would like to duck the question and just point out one thing. I first met Don Strasheim when he was the chief economist at Merrill Lynch covering the US economy. I was the chief economist at Morgan Stanley covering the U.S. economy. I think it's amazing that, you know, two guys have been able to reinvent themselves, focusing on China and moving away from the U.S. So that's my answer.
And that tells us a lot about the world. Got it.
Right.
Okay.
Is that China's biggest risk?
It may be. It may be.
It probably is. I started following China full time really in about 1998 when it was interesting. Now it's important. So that was a good.
You were always known to be early.
Good call. Yeah. So, but to the question, my biggest kind of unknown doubt, worry, whatever is. Beijing has gone back now to a political strongman system. And I worry a lot about that. So Chairman Mao was a political strongman. And then we had a period of 30 years with Deng Xiaoping and Jiang Zemin and Hu and so forth. Of consensus-driven decision-making. Now we're back to political strongman. Maybe this will work. I hope so, but I think this is the biggest risk, and I see them building a surveillance society, which has a great risk of scaring to death foreign companies who don't want to participate in China. And the risk is that in this move toward a political strongman, China becomes isolated because other countries and other companies don't want to be involved.
Can I just,
yeah, please.
I ducked the question, but I would just say briefly, my biggest concern is that we are overestimating China's ability to assume the reins of global leadership. And we are underestimating the willingness of the U.S. to abdicate its role.
I want to thank you all for being neither bulls nor bears, and for being realists and so balanced in your views. So thank you very much. A big round of applause.
Thank you for a great discussion on China's economy. Thank you. And especially on the complex dynamics of China's debt market. Thank you so much for your insight. We are now heading to a 15-minute break. The restrooms are downstairs. There will be snacks and drinks outside. Please return on time for a very excited philanthropy panel with some great speakers from China and the US. See you in 15 minutes.